The price is lying. And the real message is coming from the part of the market most people never look at. 90,000 looked like a simple number on a chart, a headline for tourists, a bragging rights screenshot for the loud accounts. But for the plumbing of this market, 90K is a pressure plate. When it clicks, the people leaning the wrong way don't get to reconsider. They get moved. And the conflict right now is that a whole ecosystem of commentary wants to explain this as vibes, while the actual driver is math, margin, and hedging flows that don't care who feels smart on Twitter. Stay with me, because by the time we get to the end, you'll have 3 levels, 2 scenarios. And one hidden metric you can watch next week that tells you early whether this is a controlled retest or the start of a continuation squeeze that rips through liquidity like a blade. And that's where the real pressure starts. When Bitcoin pushed through 90, it didn't just move up. It forced the market to change its posture in real time. Round numbers aren't mystical. They're practical. They're where orders cluster because humans love clean thresholds and where algorithms love predictable pools of stops, take profits, and liquidation triggers. It's also where option strikes bunch up, where dealers and market makers have to decide whether they're re-hedging into the move or getting pinned by it, and where a high-leverage crowd finds out instantly whether they actually had a trade or just had a story. But that's not the part that matters. The part that matters is what happens immediately after the break, when the first wave of forced flows hits the tape and the market reveals whether it can absorb them without choking. Because if this one level breaks, the math changes. And right now, the tape is telling you something uncomfortable. Price can hover around 90K, even while the surface narrative screams indecision, because underneath, multiple engines are fighting at once. Spot liquidity, futures basis, perp funding, option hedges, and ETF flows that can pull one way while derivative positioning pushes another. The word paper shorts gets thrown around like a conspiracy phrase, but in crypto, it's usually something far less cinematic and far more lethal. Leveraged short exposure built on derivatives, perpetual futures, dated futures, option structures that behave like paper because they can be created in size without anyone touching the underlying coin until the moment the collateral rules change and the exits narrow. A paper short is often a bet that price won't rise too fast, paired with the assumption that liquidity will be there if it does. That assumption is what breaks first, and once it breaks, nobody asks permission. Here's the clean, non-mystical version. Most major venues allow traders to short via perpetual swaps or futures with leverage. Leverage is a multiplier on both gains and losses, but the market doesn't give you infinite patience. You post collateral. Your position has a maintenance margin threshold. If price moves against you and your collateral cushion shrinks, the exchange forces a reduction or closure of your position to protect itself. That forced closure is not an opinion. It's a mechanical buy order when you're short. It's a mechanical sell order when you're long. So when we say shorts getting liquidated, we're not saying a villain is panicking. We're saying a risk engine is executing. And when that execution happens in a market where liquidity thins at the exact moment everyone needs it, the move amplifies itself. But that's not the part that matters. What matters is that liquidations are contagious, not because of emotion, but because they impact price, and price impacts margin for everyone behind them. Think of it as a stairwell during a fire alarm. One shove creates another, and suddenly the stairwell isn't a stairwell, it's a funnel. Liquidation physics is brutally simple. Imagine a cluster of shorts sitting just above 90K with tight collateral. Price lifts through 90K, they take losses, and the weakest accounts trip their maintenance margin. The exchange begins to close them by buying back the short. Those buys push price higher. That higher price triggers the next set of weak accounts. More forced buying, less available liquidity. Spreads widen, slippage increases, and the chart prints a candle that looks like sudden demand, when in reality it's a sequence of forced actions. This is why the move can feel violent and unearned. It's earned by the structure. And that AS where people get trapped. They watch the candle and think it's sentiment. It's not. It's margin. The next detail is what flips the whole setup. Because the hidden detail, the one that reframes the entire story, is that derivative markets can manufacture demand even when real buyers look absent on the surface. In other words, you can have price rising while the crowd argues, while headlines lag, while some flow data looks mixed. Because dealers and market makers are being forced to hedge options exposure in a way that pulls price like a magnet. This is the part most viewers never get told, because it's less exciting than whales, but it's more powerful than whales. Gamma and delta hedging. Let's make it simple without dumbing it down. Options give someone the right, not the obligation, to buy calls or sell puts at a strike price. Market makers who sell those options don't want directional exposure, so they hedge. The hedge amount is the delta, how much the option behaves like the underlying. As price rises, call options typically gain delta, meaning they behave more like owning the asset. If market makers are short those calls, they hedge by buying the underlying, or equivalent exposure, to stay neutral. The key is gamma. Gamma describes how fast delta changes as price moves. When a lot of open interest sits near key strikes, like the big round strikes around milestone levels, small price moves can force hedgers to adjust rapidly. That hedging can become reflexive. Price rises, delta rises, hedgers buy, price rises more. That's a feedback loop. And it doesn't require a new cohort of believers. It requires positioning. But here is the trap. The same system that accelerates a move can also slam on the brakes or reverse into a whip, depending on where you are relative to the strike cluster and how dealers are positioned. That's why the level matters more than the narrative. And that's why you can't treat 90K like a meme. You treat it like a switch. Now bring it back to paper shorts. Well, shorts don't only exist as a pure directional bet. There are also basis trades, strategies that short futures and buy spot to capture a premium. In contango, futures trade above spot, and sophisticated players can lock the spread by buying spot and shorting futures, earning the basis as it converges. That's not inherently bearish, but it creates short exposure in futures markets. Then there are volatility structures, selling calls, short strangles, other positions that embed short gamma. Those positions can behave like paper shorts because they become forced buyers when price rises. So when you see price challenging a milestone level, you're not just watching belief. You're watching a balance of hedging demand versus available liquidity. But that's not the part that matters. The part that matters is the tell. When price breaks and holds, you can often see the derivative scream before the spot market looks dramatic. What does that scream look like? It looks like changes in funding, changes in open interest, changes in spreads, and changes in the relationship between spot and futures. Funding is the leverage tax in perpetual swaps. When longs are crowded, funding tends to go positive. Longs pay shorts to keep positions open, because the perp price is being bid above spot and needs an incentive to bring it back in line. When shorts are crowded, funding can flip or compress because shorts are willing to pay. The important point isn't funding up equals bullish or funding down equals bearish. The important point is what funding forces participants to do. If you're long and funding spikes, you're paying rent every hour. If price doesn't keep moving, that rent bleeds you. If you're short and price rises and funding doesn't compensate you, your carry turns ugly while your mark-to-market burns. Either way, leverage becomes less stable. And instability is what turns positioning into forced flow. Right now, the live price context matters because it frames how violent the next move can be. As of this week, Bitcoin has been trading right around that 90K zone, roughly in the low to mid 90Ks earlier in the month, then slipping back toward 90K with intraday wicks flirting around it. That's not a trivial detail. That's the market telling you we're in the decision band. The market has memory. A push above 90K that fails and falls back under is not the same as a push above 90K that retests and holds. One is a stop run and reversion. The other is a regime shift in the order book. And the next detail is what flips the whole setup. The strike magnets above, the liquidation shelves below, and the calendar window when liquidity thins and hedges become urgent. Let's do the chart structure without turning this into a geometry lecture. You only need 3 zones. Zone 1 is the floor, the area below 90K, where buyers must prove they were not just tourists. Zone 2 is the pivot, that 90K band itself, because price hovering there is not boring, it's pressure building. Zone 3 is the ignition point, the overhead zone where repeated failures have created a pile of stops and hedging triggers. Earlier this month, that overhead zone has been discussed around the mid-90Ks, where price struggled to push through and got rejected back toward 90Ks. If price can reclaim and hold that overhead zone, you invite the squeeze scenario. If it can't, the retest scenario becomes more likely. But don't get hypnotized by a single line. Watch how price behaves around it. Do rallies get sold immediately, or do they get absorbed and then grind higher? Do pullbacks get snapped up, or do they slide and widen spreads? Are wicks long and violent, suggesting stop hunts? Or are closes clean, suggesting real acceptance? That's where the real information lives. Now let's talk about institutional flows without the usual mistake. People love to point at ETF flows and declare a verdict. ETFs had outflows, so this can't be real, or ETFs had inflows, so it's unstoppable. That's lazy. Flows matter, but they're not the whole machine. In early January, reported US spot Bitcoin ETFs saw notable outflows over a handful of trading days in the range of around $1 billion across 3 days through roughly January 8th, with some reporting also highlighting a rough $681 million outflow in the first full week. That sounds dramatic, and it is meaningful. But here is why it doesn't automatically negate strength. Marginal price is set at the margin. If ETFs are seeing redemptions but derivative hedging demand is increasing, spot liquidity can still be bid through other channels. OTC desks, cross-exchange arbitrage futures, hedges. and the simple fact that a shortage of sell liquidity can cause price to hold up even when buyers aren't a T euphoric. Think of it like a crowded theater exit. Even if fewer people are trying to enter, if the hallway narrows and someone starts pushing from behind, the pressure at the doorway increases. That's how marginal price can rise in the presence of mixed flow signals. But that's not the part that matters. The part that matters is the mismatch. Outflows can create one kind of selling, while shorts being forced to cover create another kind of buying. And those can collide into volatility that looks irrational. This is why you need a proof stack, not a single data point. So here's your proof stack. Mechanism first, then evidence layers that triangulate. Layer 1, liquidation behavior. When you get sharp bursts through a key level followed by fast continuation, that's often the signature of forced flow, not discretionary buying. Layer 2, funding behavior. If funding spikes into the move, you're seeing leverage chase. If funding stays contained while price rises, the move may be driven more by spot and hedging than by frothy perp longs. Layer 3, open interest behavior. If open interest rises as price rises, leverage is being added, fuel for both continuation and violent reversals. If open interest falls while price rises, shorts are being closed. Classic squeeze unwind. Layer 4, basis behavior between futures and spot. If the curve goes into steeper contango, it suggests demand for leverage long exposure or carry opportunities. If the basis compresses or flips toward backwardation, it can signal stress, hedging demand, or risk-off posture. Layer 5, cross-market tells, like how the dollar and real yields behave or how correlated risk assets respond. Bitcoin doesn't trade in a vacuum, especially when macro liquidity is the tide. Layer 6, the on-the-ground symptom, spread and depth behavior. You done a T need a professional terminal to feel it, and when the market starts moving and liquidity thins, you'll see faster slippage, more wicks, and a market that can jump levels with fewer prints. Each layer alone can mislead you. Together, they describe a machine, and that's where the real pressure starts. Now we have to address the Fed's scrambling angle in a way that's finance credible, not cartoonish. The Fed doesn't have to cut tomorrow for markets to start trading the path today. The relevant driver is the trajectory of inflation, labor conditions, and the market's perception of how constrained the Fed is by growth and fiscal dynamics. This week, macro chatter has included unusually aggressive calls for cuts from at least one prominent Fed voice, floating the idea that substantial easing, on the order of more than a full percentage point over a year, could be justified if inflation trends cooperate and labor softens. Whether you agree or not, the market hears that as permission to price a softer path. And when rate cut expectations accelerate, real yields can compress, the dollar can wobble, and duration-sensitive risk assets can re-rate. Bitcoin is a strange hybrid, part risk asset, part liquidity barometer, part collateral narrative. It often responds to the same liquidity impulses that push other speculative assets, but it can also behave differently when its own market structure is under stress or under squeeze. So when people say the Fed is scrambling, translate it into incentives. Policymakers want financial conditions not to tighten too violently. Markets want a path that keeps liquidity from drying up. And everyone is trying to front-run everyone else. That front-running creates volatility. But here's the next detail that flips the whole setup. The calendar is the catalyst. Early January is not just a new year. It's a positioning reset. Funds rebalance, risk limits get refreshed, dealers roll books, macro narratives get repriced, liquidity can be thinner at odd hours, and weekend gaps still matter in crypto. Because even though it trades 24/7, the deepest traditional liquidity, especially for some institutional hedging, still clusters around weekday sessions. That's why you often see moves accelerate during thin windows. Fewer resting orders, wider spreads, more slippage, and a higher chance that a single forced flow triggers a chain reaction. Add to that the option cycle. As you get closer to key expiries, monthly expiries, quarterly cycles, whatever is dominant on the venues that matter, strike magnets can intensify. If the market is sitting on a strike cluster near a milestone level, dealers can have an incentive to pin price, or they can be forced to chase it, depending on net positioning. That os is why the same market can feel dead for hours and then move like a trap door opens. And that's not the part that matters. The part that matters is what it forces participants to do. Let's flip the camera for a second and look at the other side. The desks, the market makers, the carry traders. If you're running a basis strategy, you care about the spread, not the headline price. Your risk is that volatility spikes and your hedge relationship breaks down temporarily, or that funding flips against you, or that liquidity dries up and you can't roll efficiently. If you're a market maker, short calls into a rally, you may be forced to buy into strength to maintain neutrality. If you opt for short volatility, selling options for income, you may suddenly find your income strategy turning into a directional disaster because gamma works against you when the underlying moves fast. And if you're a leveraged short with a thesis that this is overbought, you may be right eventually and still be vaporized today. That is the core lesson retail has to internalize. Being right in direction isn't enough. You have to survive the path. Volatility is not a side effect. It is the weapon, and it will be used against you psychologically. The market will green candle you into FOMO, then red candle you into shame, then chop you into exhaustion until you start making decisions just to stop feeling things. That's the trap. The antidote is a framework that separates trend signals from noise, and a plan that respects invalidation levels. Because even if the bull thesis is correct, price can whip around violently and still be right. Let's talk about the paper versus physical analogy for the metals crowd, because it maps cleanly if you translate terms. In gold and silver, you've heard the tension between futures positioning and physical availability, the idea that paper claims can expand far beyond immediate deliverable supply until stress shows up as premiums, backwardation, or delivery dynamics. Crypto doesn't have warehouses in the same way, but it has a functional equivalent: clean spot liquidity, credible collateral, and the ability to move size without dislocating price. When that deliverable liquidity is abundant, paper positioning can lean heavily without consequence. When it tightens, because depth is thin, because risk limits tighten, because dealers are positioned wrong, because volatility spikes, paper positioning gets vetoed by reality. That's what a squeeze really is. Not a moral event, a mechanical event. Now, you need to know what can go wrong, or you'll become exactly the kind of viewer volatility preys on. Here are the credible counterpoints, the ones that don't require drama. 1. ETF outflows can continue and become persistent, reducing one important demand channel and changing the tone of dips from bought to sold. 2. Macro can flip risk off fast. An inflation surprise, a growth scare, a geopolitical shock, or sudden repricing in yields can hit liquidity and crush speculative appetite. 3. Leverage can overheat. If funding spikes and open interest balloons while price stalls, that's a setup for a long liquidation cascade, the mirror image of short liquidations. 4. The 90K level can become a trap. Markets love to reclaim a level. Bait late buyers, then dump through it to harvest stops and reset positioning. If we see repeated failures to hold 90K on a closing basis, with lower highs and weak rebounds, that weakens the immediate squeeze thesis. 5. Regulatory or operational headlines can create sudden gaps in sentiment even if structure is otherwise supportive. None of these invalidate the long-term narrative by themselves, but they can absolutely invalidate the next week's setup. And that's what we care about, what happens next week, not what makes for a dramatic thumbnail. Because if this one level breaks, the math changes. So here's the 2-scenario lens, and you should tattoo it mentally because it keeps you sane. Scenario 1 is the controlled pullback and retest. Scenario 2 is the continuation squeeze with gap risk. The market will tell you which script it's running, and it will do it early, if you're watching the right things. In the controlled pullback scenario, price pulls back like it's giving up, maybe even dips below 90K intraday to shake people out, but it finds buyers in the floor zone and then reclaims. You'll see volatility, but it will feel like absorption rather than panic. Funding will cool off or stay reasonable. Open interest might drift lower as weak leverage exits. The basis between futures and spot will stabilize rather than spike erratically. And importantly, you'll see that dips get bought with intention, meaning rebounds don't immediately get sold into. This is the market testing whether 90K has turned from ceiling into floor. A clean retest is healthy. It frustrates everyone. Bulls hate it because it feels slow. Bears hate it because it refuses to break. That frustration is the point. It rebuilds structure, but that's not the part that matters. What matters is the confirmation. Higher lows, cleaner closes, back above the pivot, and a reduction in the liquidation spike signature. If instead you see repeated closes below 90K, rebounds that die instantly, and widening spreads on down moves, that's not a healthy retest. That's weakness. Now, scenario 2, the squeeze case, is the one people fantasize about, and the one that punishes sloppy execution the hardest. In the squeeze case, you don't get clean entries because the market starts ripping liquidity off the screen. Price reclaims $90K with urgency, pushes into the overhead zone where it previously failed, and then instead of rejecting, it chews through it. If that overhead zone gives way, you can get strike-to-strike movement as option hedging flows chase. You can also see shorts scramble and close, which can appear as open interest dropping while price rises, classic squeeze unwind. Or, in a more dangerous variant, you can see open interest rising into strength, meaning fresh leverage is piling in, which fuels continuation, but also sets up a brutal reversal when the move pauses. The confirmation tells here are specific: quick reclaim and hold above the pivot, increasing momentum without immediate mean reversion. Liquidation bursts skewed to shorts rather than longs, in a market that spends less time negotiating at levels and more time teleporting between them. That's where gap risk comes in. In thin liquidity windows, overnight sessions, weekends, post-news bursts, price can jump before you can react. That's why risk management is non-negotiable. You don't have to trade it, you have to understand it. Now let us make these mechanics pay off concrete. What should you watch next week that actually tells you which scenario is winning? Start with the pivot behavior around 90 Kazakhs. Not did it touch, but did it accept? Acceptance looks like multiple closes holding, dips being bought quickly, and pullbacks failing to accelerate. Rejection looks like repeated failures, weak bounces, and a creeping lower high structure. Second, watch the overhead zone where price previously stalled in the low to mid 90Ks. If price breaks into that zone and gets slapped down repeatedly, that's overhead supply and hedging pressure. If it breaks and holds, that's a regime change. Third, watch funding. You don't need to worship funding, but you need to respect it. If funding screams higher while price chops, that's a warning. Leverage is paying rent while going nowhere, which often ends with a flush. If funding stays contained and price grinds, that can be healthier. Fourth, watch open interest directionally. Rising OI into a breakout means leverage is being added, fuel and fragility. Falling OI into a breakout means shorts are being removed, squeeze signature. Fifth, watch the spot versus futures relationship. If futures start pricing an unusual discount or the basis compresses sharply, that can hint at stress or aggressive hedging. If the curve stays orderly, it suggests the move is being digested. Sixth, watch the macro pressure points, the dollar, real yields, and the cadence of rate cut expectations. You don't need to become a Fed historian. You just need to know whether liquidity conditions are easing or tightening at the margin, because even the cleanest crypto structure can get steamrolled by a sudden macro shock. And that's where the real pressure starts. Now, let's address the emotional game directly, because this is where most retail loses even when their thesis is right. Volatility will whisper two lies. Lie one, you're late, you have to chase. That "my" is how you buy into the part of the move that exists mostly to liquidate someone else, mess risk. Lie two, it's over, you have to bail. That "and" is how you sell into the part of the move that exists mostly to harvest stops and reset positioning. The market doesn't need to conspire to do this. It happens because of incentives. Dealers need flow, exchanges need liquidations to be contained, large players need liquidity to enter and exit, and liquidity is best harvested from predictable human behavior. So build a psychology shield. Decide in advance what you consider trend signal and what you consider noise. A trend signal is a break, retest, and hold of a major level with supportive structure, clean closes, constructive pullbacks, and a derivative profile that isn't overheating. Noise is an intraday wick that exists to punish impatience. Trend signal is what persists. Noise is what provokes. And here is the most important line. You don't need to predict the next candle. You need to recognize which scenario you're in and react with discipline. If you're wrong, you want to be wrong small. If you're right, you want to stay in long enough to matter. That's the entire game. And SY, paper shorts, is a useful phrase only if you understand it as forced buyers waiting to be created, not as a villain story. So what comes next, in plain terms? Next week is likely to be a fight over acceptance above 90 Keller. If acceptance holds and the market can reclaim the overhead zone where it previously failed, the squeeze case remains alive, and the next magnet becomes the next major round number region above, where strikes and stops typically cluster again. But if acceptance fails, if 90K can't hold on closes, if rallies get sold instantly, if funding spikes into chop, if open interest balloons without progress, then the market is telling you it needs to reset. That reset can be constructive or it can be painful. Constructive looks like a controlled pullback that forms a higher low than reclaims. Painful looks like a liquidation flush that overshoots because too many late longs built positions on borrowed time. Either way, the thesis can remain intact while the path is brutal. Price can whip around violently even if the direction eventually resolves higher. Don't confuse discomfort with invalidation, but also don't confuse hope with structure. If the floor zone below 90K breaks cleanly and stays broken, and if the market starts printing lower highs with weak demand response, that weakens the near-term bullish setup. It doesn't mean crypto is dead. It means the machine is doing a different job, deleveraging. And deleveraging is a job that can take longer than your patience. Here's the subtle CTA, and it's not begging, it's a filter. If you're the kind of investor who wants to understand the plumbing, not just repeat narratives, stay in this community. Because the edge isn't T, predicting the next candle. It is reading what the market is forcing participants to do before the headlines arrive and after the hype wears off. Keep your eye on the pivot, the overhead zone, the derivative pressure signals, and the calendar windows that make liquidity thin and hedges urgent. And remember the hidden detail. Sometimes the market moves not because everyone suddenly believes, but because the hedge math demands it and the exits aren't wide enough for the people leaning the wrong way.